Hi, this is Joseph. In this video, I'm going to cover and review a simple day trading strategy. It's something that I use on a 5-minute chart, and I use the 1 hour time frame to confirm the trend direction. Now, what this day trading strategy is basically looking for an established trend and then waiting for a slight pullback to get into the trend as it resumes and then continues for that next leg down or in a upward movement. So I have a PDF workbook that will outline all of the detailed step-by-step rules to this particular strategy. I'll go over it here in the video too. But if you don't have that PDF, if for whatever reason you can't find it on the website, send me an email at forexautomatedtradesignals.net and I'll send it to you. So what we're doing here is you can see that I'm using a bar chart. I prefer to use bar charts, but candlesticks are just fine. I mean, it's totally acceptable. And I'll mention a few things a little bit further into this video about why I think that bar charts are a little bit better, at least the way I look at it. But again, this strategy can be used and applied with the candlesticks. The only indicator that I'm using here in this instance is a 20-day EMA. That's it. That's the only real indicator. And the only reason why that indicator is on the charts is to highlight and to bring to my attention when I'm visually looking at the charts and looking for an opportunity, the direction and the strength of that trending movement. I want to see that the moving average is in approximately a 45-degree slope, either to the upside or to the downside. Now, we call this strategy the 45 and 45 because the first step is to make sure that the trend is in a 45-degree angle, whether again up or down, and it needs to be approximate. You know, the closer it is to the 45-degree slope, the stronger it is. If you look at this area right up here at the top, you can see that this is quite a bit of consolidation. So you can tell by the slope right here of the moving average, it's not at a 45-degree slope. You know, neither is this. And when it starts to move back and forth, you know that you've moved into consolidation. Now, there's a few things that you want to do or to realize that in order to make this trade strategy work even more effectively for you, you want to have the right skills or the right chart reading skills. So you need to be able to have the ability to identify consolidation, regardless if, you know, it's accumulation or distribution. We'll talk about that in another video. You want to be aware of key levels of support and resistance. And one of the things that you can do to find those levels is to go to the larger time frames, like the 1 hour, the 4 hour, and the daily. So just keep that in the back of your mind. Now, we are using key levels of support and resistance as targets. So in this case, when you see price bottoming out down here, it was just a few points away from a key level of support that I could see on the larger time frame. So it was very easy for me to trade it off the 5-minute chart right into that support zone and then close out the trade. When I'm looking at price and watching it go to my targets, it is possible that price could stall and not reach that support level. It may not touch it on the level. Sometimes it'll fall right at that support level, you know, the old level over here to the left. It is possible that it will stop almost to the number and then bounce. Other times it'll, you know, break through it and go lower than that, maybe 10, 15, 20 points below it, and then turn around and come back up. And then other times it will stall and hang out just above that support level. So that can be kind of confusing. And what you need to do in a situation is you need to learn how to read these bars. There's a lot of data inside of these bars. One of the things I teach my coaching clients is how to read these bars and to look for ultra high range bars. So what we're looking at is, you know, relative to the previous small range bars, you can see from the high to the lows, it's not really going too far. There's not a whole lot of activity. There's not a lot of urgency. And as it starts to drop through this zone right here of support, you can see that these bars are expanding. You're paying attention to where they open, where they close. Are they closing at the lows? What's the range of that bar compared to the previous bars? Things like that. And then here you have this ultra high range bar to the downside. And it really doesn't necessarily give us a reversal signal, and it really provides a lot of momentum. Now, you could also add the volume indicator, but I don't want to turn that into, you know, another lesson about volume because we could talk about that for 2 or 3 or 4 hours. But I highly recommend, you know, spending some time learning how to read the volume indicator. That's really the only indicator that I use. The 20-day moving average, again, is just a guideline. So let's talk about the entry and the signal itself. Now, in a downtrend, what we're looking for is a specific bar that moves to the downside, right, in the direction of the trend, and then pulls back up and closes at least 45% off the lows. 45% or higher. So in this case, it could be 60, 70, 80%. That's good, right? That's what we're looking for. We're looking for a bar that moves to the downside in the direction of the downtrend and then rolls right back up. And then there's a little bit of buying in there, and you see it close about 45% or higher off the lows. That would be one of our signals. But we need to make sure that this moving average is pointing in a 45-degree or close to it, that kind of slope. It needs to be in a 45-degree slope, indicating that this trend is relatively still strong and we could expect it to continue to the next support zone. Now, you also want to take a look at the background. You've probably heard that before. And what they mean by looking at the background is, again, are we in a downtrend? If we were to go to a larger time frame, we would see that this has been in a pretty steady downtrend, even with this area of accumulation. I'm sorry, redistribution. This was an area of redistribution. It was just sort of a temporary sideways pause of consolidation before it made another move to the downside. That's what we could see on the larger time frames. So take a quick look. Make sure that you're trading it in the direction of the overall trend. I feel that it's a really big mistake to just execute this trade, the 45 and 45, with just the 5-minute chart by itself. It can work in some cases, but you're going to experience some losses because you're not paying attention to the larger time frames and the overall bigger picture trending direction. If you can take a quick look and make that a habit, look at the 1 hour, make sure that the daily, you've already done that before you sit down to work. That's what improves the number of winning trades that I have, is being prepared and knowing which direction I'm going to be likely trading it in anyway. So these things will help you. Now, if we have the candle that closes 45% off of the lows, that's my signal candle. Now, what I do is I wait until price continues in the same direction to the downside, and it has to go at least 10 points lower than the low of the signal candle. Now, this signal candle has a low of 30,809. So I can't get in until 30,799 or 98 in this case. That's just where I happen to drop in the price tag. So about 10, maybe 11 or 12 points below the low, and that's when I get into the trade. And my stop is going to be back up here at the high of the moving average that's associated to the signal candle. So let me put the crosshairs in here. And you can visually look at this. In the heat of the moment, you want to be able to find it and size it up quickly. So I have to wait until this candle closes. That's the first thing, is wait until the candle or the bar closes, confirming that it's closing 45% off the lows, and then figuring out where my stop loss is, right up here at the 20-day moving average. And then I can figure out where my targets are. And I think in this case, this was about 96, 95 points stop loss, and this was about a 120-point gain. Now, I mentioned being able to develop the ability to read the bar charts. That's a very important skill. Every trader should master the ability to read the bars and to determine if you're likely to see a reversal just based on the bars themselves. You've probably seen, if you've been in this business long enough, people who claim to be able to read the charts without any indicators. That is, for the most part, what I'm doing. I'm only using this 20-day moving average as a guideline to show me the direction of the trend and the strength when I'm scanning across multiple charts looking for an opportunity. Because I use this trade on the US 30, but I also use it on Forex. So I'll have several windows open on the 5-minute chart, and I'm going to be watching this 20-day moving average and seeing where price is in relation to that. And then I start to get in a little bit deeper when I think I've got a signal and I see a breakout and some kind of a established move, trend. So again, when I'm trying to figure out where to take my profits, I don't want to give back too much of my profits if it stalls just above support and then bounces and pulls away. So I've got to be reading these bars, and the way you develop the ability to read these bars and the information in these bars, you can see that this is likely to print some kind of a reversal, and it's going to come back up here. There'd be no reason for me to let price roll all the way back up here to this support just because, I'm sorry, this resistance, just because it doesn't hit support on the number. You have to be prepared for that. If you hold out for every single last point, you're probably going to turn a winning trade into a losing trade. So you have to develop the skill of being able to read the chart so that you can determine it's just not going to go any lower. This is an area where it's likely to either go sideways, experience a deep retracement and a pullback, which would then give back a lot of profits. You don't want to sit into the trade another 24 hours hoping that it's going to come back if it's going to provide you 100 or 120 points or even larger than that, maybe even 400 points, because this trade can certainly develop into some kind of bigger move at the open, the New York Open, and then it could continue to trend for the rest of the day. That is a possibility. It happens fairly often. It's just you have to wait for the opportunity to develop. So again, great opportunity, great trade. The trades are usually more than one-to-one reward to risk. So keep that in mind. I mean, sometimes you're going to find these trades are going to pay double or maybe even triple what the risk is. Let's take a quick look at this pattern and this setup in an uptrend. So in this example, I'm going to resort to the images in the uptrend trade that we use in the PDF manual. So again, you can get access to this PDF manual if you want it. It includes the rules and the setup and the timing. So here we have an uptrend. Again, same US 30. This is a 5-minute chart. Here's a little breakout. Now you can find additional patterns like head and shoulders patterns, accumulation distribution, qualities to the range before the breakout. You'll be able to find, if you know how to read the charts and you have experience with this, they'll confirm the breakout and the uptrend anyway. It's just the only thing we're talking about here in this video and in this PDF is the precise entry based on one particular type of candle or bar chart, bar. That's all we're doing. That's all I'm sharing with you in this example. Again, you can find a good, I guess I should say a better opportunity if you have the skills to be able to look back over here at the left and to confirm the breakout, the testing, the moves above, the high on the pullback. I want to go and resort to these Wyckofffian principles and start calling, phase B, phase C and D when it breaks out, and then, the selling climax, the automatic reaction when it breaks out above. These are other things that I'm applying to the charts as I'm doing that. But you can do this just by simply looking for this particular bar or candle setup right there using these rules. Again, here you can see this is the signal candle right here, and in an uptrend, we want to see a bar or a candle that closes at least 45% off the highs. Remember, in the downtrend, it was 45% off the lows and it pulled back up. In this case, it's off the highs and it drops back down. So here is the perfect signal right there. Again, it can be more than that. It can be 50, 60, even 70% off the highs, but it needs to be at least 45% off of the highs. And then the uptrend, the trend line, the 20-day moving average, has to be in approximately a 45-degree slope. That's what you can see here as far as these rules. Everything is there. Now let's go to the next slide so you can see the entry, the stop, and then we'll finally look at the take profit level. So here we have the entry is 10 points above the signal candle high. So you can see here we got in at 30,841. The stop loss again was back down here at the moving average, the 20-day moving average, based on the signal candle itself. You don't want to change that. You want to stick with that rule. It helps. So, you can calculate the distance here. And then our targets are going to be the next level of resistance. I'm going to show you that in this case, there were two different levels, two different resistance levels. I'll talk about that in a moment. So here you can see the two different profit targets. Now, what would cause you to close the trade at the first and not hold to the second? Well, here's what I'm going to go back to, which was the idea that you develop the skill to be able to read these bars or even candlesticks and to pay attention and learn how to gather the information, the data that's contained within even a single bar. You can determine what's likely to happen next based on the bars over here to the left. This is a concept that Wyckoff used to talk about. You've probably heard of a gentleman named Richard Wyckoff back in the early 1900s. He talked about these concepts and these abilities to be able to figure out what's going to happen next based on the information that the market has already provided for you. You want to learn how to read these bars. And what we're doing, again, I'll go back to it, is gauging the range, which is the size of these bars from the high to the low, the open, the close, where is the close in relation to the high and the low, and what is the next bar telling you. You can tell that it's blasting off through this area of supply as you see these strong bullish bars closing at the high. This is a psychological component that I talk about with a lot of my coaching clients. We look for this as we see price taking out an area of resistance to determine if it's going to stall at resistance and then turn around and come back, or if it's going to take off and push through this area of resistance and keep going. You need to learn how to read this data that's here to calculate where is a typical or where is a possible area of supply, why, what does it look like, what happened over here, and then what do these bars look like and represent as they're trying to buy price, pushing it up through this area of supply so people don't let go of the trade, and it makes it a lot easier for smart money to continue to watch this move go up into the next area of resistance. This dotted line right here, this dotted resistance level, is the next significant level of resistance on the larger time frame. So you can see here, it didn't tag that level precisely on the spot. It fell just short of it. So again, being able to read these bars and to determine that this is as far as it's going to go, we're likely to either see a deeper pullback and a correction, or it may be that it's a total reversal. So you need to know how to read the charts so that you can figure out whether you can hold on to these trades a lot longer, earning more profits. But in the beginning, if you don't have that skill, then certainly just trade it to the first level of resistance or the first level of support, depending on which direction you're trading it in. And then over time, as you make money, you'll be able to develop the skill so that you can read the charts. You don't need indicators. Indicators aren't necessarily going to help you determine what's going on here as you see price going through there. Volume and the bars themselves and the activity, the information and the correlation between the bars and the activity, the price action and volume is what's going to help you calculate whether or not this is going to, if it's a smart money play and they're pushing it up through an area of supply and it's going to continue to go higher, or is it just sort of a little top here and it's going to reverse and come right back down to the previous lower levels. Which, again, if you do that and you hold on too long, you don't know how to read the charts, you could give back a lot of profits or turn a winning trade into a losing trade if it comes back down into your stop and you just don't know where to take profits. Be careful with this. So you need to figure out where your profit targets are as and even before you get into these trades. So again, honor the stop loss. We call it the 45-45. It's got to be a 45% off the highs or the lows, a candle or a bar. That would be your signal. And then in the 20-day moving average needs to be in a 45-degree slope, either up or down. And that would help you with the confirmation and the strength of that trend. Now, if you're still struggling with ideas like this, and you're still a little fearful in executing a trade like this is going to take some practice. I wouldn't recommend immediately jumping into your live account and trying to execute this trade. Study it, back test it, paper trade it for a while, then demo trade it. It's going to take you a few weeks, maybe even a few months to get this skill down. But if you're still struggling and maybe you're in a hurry or you're trying to pass a funded challenge to get a live funded account, you can use my trade copier. And this is a great opportunity. Like you can see that this is, as a result of learning this strategy in this video, you can see this is one of the techniques that I use when I take some of these trades. This is not the only one that I look for. I do trade breakouts. I do trade, inside of accumulation distribution, phase C. I talk about that quite a bit in some of my other videos. We'll leave it at that. If you want to find that, you can go to my YouTube channel and I'll talk more about that. But use my trade copier and it will copy all of my trades and you don't have to worry about making any mistakes. But at the same time, while you're copying my trades with my trade copier service, you could certainly earn profits. You could certainly pass your funded evaluation and get a live funded account and continue to use my trade copier for that live funded account so you can send home profits every single month. But in the meantime, during all of that, Even if you continue to use it for 3, 4, 5, 6, 7, 8 months, you can take the time at that point to learn some of the trading techniques that I use in my system so that over time you could eventually do this yourself. Thanks for watching.